Warren Buffett is, without a doubt, the most famous investor of all time, and certainly one of the greatest. If his track record of decades and decades of above-average returns doesn't impress you, his nearly $90 billion net worth will. Anyone looking to replicate his financial success should follow these methods. Buffett is first and foremost a value investor. A value investor is someone who buys stocks that they believe are trading for less than their intrinsic value. Intrinsic value is the true value of a company's shares, not necessarily what price they can be bought for. In his earliest days, Buffett was able to invest in companies with book values lower than their cash on hand, or companies who were so undervalued that they were seen as less valuable than their liquid cash reserves. When the market would correct, Buffett would rake in enormous profits. While in today's world of instant information, finding a company with more money than market cap is pretty much impossible, there are still loads of stocks that are undervalued by Mr. Market waiting for investors to find them. Buffett looks for what he likes to call an economic moat. An economic moat is a durable competitive advantage. One common type of moat is lower prices. Assuming two businesses produce very similar products of the same quality, the product with lower prices will win out in the end. However, there is very little to stop competitors from offering similarly low prices, resulting in a vicious cycle of lower and lower margins. The type of economic moat that Buffett seeks out is what is known as the qualitative moat. His investments in Coca-Cola are an example. Coca-Cola's recipe cannot be replicated by competitors, and thus the company is able to enjoy a strong competitive advantage of superior taste. Buffett doesn't see himself as buying stocks, but rather as buying companies. He doesn't obsess over daily volume or track the short-term price movements of shares like a trader or technical investor would, but rather the business's bigger overall picture, which would include strong fundamentals, consistent earning power, stellar management, and the potential for continual growth. In his own words, it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. But ultimately, what Buffett owns his investment success to is his ability to invest for the long run. Buffett understands that forecasting the long-term financial performance of a company is much, much easier than the short-term performance. Unless the business experiences some major form of upheaval, the longer an investment is held, the more objective and less emotional an investor will act. As Buffett says, if you won't hold a stock for 10 years, you shouldn't hold it for 10 minutes.